Setting effective budget timeframes is a cornerstone of organizational planning and control. In this briefing, we will examine the tools, methodologies, and practical applications required to manage budgets with precision.
Our agenda is structured into 4 sections. We will begin with the essential tools for performance tracking, followed by a methodology for seasonal budget structures. We will then analyze 2 distinct case studies, one from the not-for-profit sector and another from a manufacturing operation.
Let's start with the foundational components for effective budget monitoring. These are the tools that transform a static budget from a simple document into a dynamic management instrument.
Milestones are defined as specific points in time that signify the completion of a major task or event. They function as critical checkpoints to assess whether a project is progressing on schedule and in line with its objectives.
Performance indicators are the specific metrics used to measure success against set goals. These can be financial, such as revenue growth, or they can be non-financial, like customer satisfaction metrics.
So how are these tools formally integrated? The process involves 4 steps. First, identify the project milestones. Second, define the corresponding performance indicators. Third, it's crucial to confirm that both are achievable and, importantly, measurable. And finally, they must be included as line items within the budget to ensure proper resource allocation.
We now turn to a critical methodology for many organizations: seasonal breakdowns. For any business with predictable fluctuations in activity throughout the year, structuring the budget to mirror these cycles is essential for accurate planning.
Seasonal periods involve dividing the annual budget into specific time frames that align with the natural operational rhythm of the business. This approach allows for far more accurate forecasting and resource management.
Let's consider 2 clear examples. A surf school's summer period involves high demand, requiring additional staffing and marketing spend. Its winter period, by contrast, is focused on maintenance with reduced staffing. A restaurant experiences a similar pattern. The key principle here is that a single, flat budget is inadequate. Each season requires a distinct financial plan.
The implementation is a systematic process. First, identify the relevant seasonal periods for your organization. Second, review historical data to establish trends. Third, allocate funds based on the expected level of activity for each distinct period. And fourth, you must continuously monitor actual performance against the budget and be prepared to make adjustments.
Now, let's observe these principles in a practical context. Our first case study examines the operational budget of a not-for-profit organization, the ABC Foundation.
Here we see the annual financial summary for the ABC Foundation. Total revenue derived from donations, grants, and fundraising is $800,000. Total expenses, including salaries, rent, and program costs, amount to $600,000.
This results in a net income for the ABC Foundation of $200,000. This represents the surplus available for reinvestment into its core programs and mission. So, how is this budget actively managed? Through a combination of milestones and performance indicators. For instance, a key milestone is to secure 2 new grants in the second quarter. A related performance indicator is the monthly monitoring of the donation revenue stream. This allows management to track progress and make timely interventions.
For our second case study, we shift to the manufacturing sector to analyze how Peak Performance Cycles, a bicycle manufacturer, constructs its operating budget.
In a manufacturing context, the entire budgeting process is sequential and must begin with the sales forecast. All subsequent budgets for production, materials, and labor are directly derived from this initial forecast. Peak Performance forecasts sales of 129,000 bikes, generating revenue of $116.1 million. However, the production budget calls for 131,000 bikes. This variance is intentional. It allows the company to meet sales demand while also increasing its ending inventory by 2,000 units.
With the production target set, cost budgets can be calculated. Material purchases are budgeted at just over $21 million. Direct labor costs are projected to be nearly $5.8 million. And total manufacturing overhead, combining fixed and variable costs, is budgeted at approximately $1.7 million.
Here is the final operating budget summary. We begin with total sales revenue of $116.1 million. After subtracting the total cost of goods sold, we arrive at a gross profit of roughly $87.5 million. Finally, after deducting selling and administrative expenses, the projected net operating income is just under $85 million.
As demonstrated, a structured approach that utilizes milestones and seasonal analysis elevates budgeting from a mere accounting exercise to a strategic tool. The question for you to consider is this: how can your organization refine its use of these methods to transition from simple budgeting to true strategic financial planning?